Good morning or good afternoon, depending on where you're joining us from. Welcome to Fogel and Potamianos presents the 2025 Portfolio Company Outlook, Strategy and Paths to Exit. We are so excited to have you here today. This webinar, this virtual panel will be recorded and will be sent out to everyone that is not able to attend and that is attending today. We have an amazing group of panelists today. We are so excited for just the breadth of experience that we have here today, and we will just get right to it. First, we have Vince Shea. Very nice to meet you and see you today, Vince. And Vince is the managing director at Cypress Growth Capital. Vince, why don't you tell us a little bit about yourself?
Christina, thanks for having us here today. Vince Shea with Cypress Growth Capital based here in Dallas, Texas. I'm a two-time exited founder and now an investor with Cypress Growth Capital. We invest in emerging growth and growth stage technology companies across the United States.
Oh, thank you so much, Vince. It's such a pleasure having you here. Next, we have Max Serebryakov, and Max is the co-founder of Sonos. And Max, why don't you tell us a little bit about yourself?
Yeah, thanks, Christina. So I founded Sonos in 2020. Today, Sonos is really fascinating company. It's a company that is probably the only successful edge AI profitable startup in Silicon Valley. What we do is we do real-time accent translation, language translation. So we deploy locally, and yeah, the business is crushing it. Mostly sell to call centers and enterprises.
Amazing. So excited to have you here, Max. Thank you. Next, we have Adam Sterling, and Adam is the Associate Dean of Executive Education and Strategic Partnerships at Stanford Law School. Welcome, Adam. Give us a little bit more about you.
Yeah, thanks. I'm a former, in a past life, failed tech founder turned VC lawyer. I also am the creator of a program called VC University with the National Venture Capital Association.
Awesome. Thank you so much, Adam. We're so excited to have you. And then we have Glenn Gow, the CEO coach. Glenn, why don't you give us a little bit more about you?
Great to be here. Thank you for hosting this. I am the CEO Success Coach, the only CEO coach who was a CEO for 25 years and a venture capitalist for 5 years. I was trained by a CEO coach for 17 years, and now I help CEOs achieve what they never thought possible while enjoying the journey. Also, I host a podcast called The Scaling CEO. Thank you.
Amazing. Thank you so much, Glenn. We are so excited to have you here. Jerome Fogel is the co-founder of Fogel and Potamianos. Jerome, give us a little bit more insight into your background.
Thanks, Christina. Glad to be here. Name again is Jerome Fogel, a co-founder and part of the corporate practice group at Fogel and Potamianos. We're a Chambers and Partners ranked boutique law firm that focuses on corporate law, venture capital, and sports. And in corporate, we do a mix of M&A, general counsel, and compliance. And for venture capital, we do both formations and deployment of capital. Thanks for having me.
Thank you so much, Jerome. And then my co-host, my co-moderator, Constantine Potamianos, also co-founder of Fogel and Potamianos. And take it away, Constantine. Tell us a little bit more about you.
Thank you, Christina. Unusual background, but that's par for the course for this firm. Originally engineering and later computer science. Started a couple of technology companies, went to grad school, got my MBA, got my law degree, and then practiced corporate and securities law out of New York for a number of years. Went back and forth between that and technology investment banking. Spent time within companies. In addition to founding startups, was also part of large companies, NASDAQ publicly traded companies. And then had the pleasure of partnering up with Jerome to form Fogel and Potamianos. And we really try to bring a holistic viewpoint to our clients and businesses, because we've basically sat on all sides of the table.
Thank you so much, Constantine. And my name is Christina Lowe. I'm the executive director here at Fogel and Potamianos. A little bit about me. I came out to Los Angeles to be a television host and work in entertainment, which I did for about 11 years on different shows here and there. And I've landed here at Fogel and Potamianos, and I love what I do. So we are so excited to have you all here. Let's get right to it. We have so much to talk about today. Let's throw it to you, Vince. One of the things that you have brought up was that when you look back at companies that have successfully scaled, what's one thing that they did early that set them apart? Oh, we're muted. There we go.
Yeah, sorry about that. I had myself on mute here. Yeah, I would say the one thing that sets apart some of these successfully scaled companies, both my experience when I was on the operating side, but also now as an investor and seeing this happen over and over again, is a focus on ruthless prioritization. At one point, one of my business school classmates was the head of sales at Facebook from roughly call it 80 people to 8,000 people. So kind of early days of Facebook, relatively speaking. And we had him at one of our sales workshops for my second company. And he mentioned the word ruthless prioritization to our entire sales team. The concept there being that even at Facebook with millions of dollars or whatever they had in the bank and all these resources, even they had to ruthlessly prioritize what they did every day to succeed. I think that's the biggest thing that sets apart some of these scaling companies. We're not talking about getting the first dollar of revenue, the first $100 of revenue. We're talking about actually being able to successfully scale to larger numbers and larger ranges of everything. And that takes prioritization of your resources, your people resources, your financial, your time focus, all that.
Vincent, I'll add one thing that I thought has always been critical, particularly at the startup stage, but I think it factors out as you continue to grow the company, and that's the importance of the team that you have working with. Prioritization requires having the right people with the ability to prioritize and execute, right? So
That's right.
I always found that was a really critical component of making sure companies bring in the right talent to begin with and continue to do so as they scale.
Yeah, and on that note, one thing I would say is that we invest relatively early stage. We're investing in companies that are maybe 3 million or 5 million plus in revenue, up to maybe 10 or 15 million revenue. So not beginning like garage startup, but relatively early stage. And when we look at companies, over 80% of our assessment is of the leader, the founder, the founding team, the management team. Can he or she recruit a great team around them? We always say that getting from 0 to 1 could be an individual sport, but getting from 1 to many is a team sport for sure. And we want to make sure they can assemble that team, recruit them, incentivize them, and build the team around it.
Vincent, I'd like to add on to the ruthless prioritization. I love that one. And the challenge, what I see with scaling CEOs is it is so hard to ruthlessly prioritize, because what that ultimately means is great ideas and great concepts are just not going to be executed. We have to actually choose to not do certain things. And I'm continually talking to CEOs about how do you make those decisions? And it takes a team to come together. The CEO is definitely going to make the final decision, but we need everybody in the room to make the decisions about how are we going to focus. And I personally like the 90-day sprint concept held within the OKR framework to have everybody focus ruthlessly on a certain small number of priority items. So I really, really love your concept. Thank you for sharing that.
And that most important word in there is ruthless, not prioritization. We all think we can prioritize, but to ruthlessly do it sounds kind of crude. And this is obviously a little bias coming from now an investor side, but having again been on the other side before, I think that's where sometimes the outside perspective of either your investors, lawyers, accountants, whatever, people from the outside looking in can sort of be a good sounding board for entrepreneurs to be able to make those prioritization decisions.
What I have sometimes seen, and it's not across the board, it's not a generalization, but I've seen a lot of CEOs, particularly tech CEOs, that are visionary. They see a grand vision of where they want to take this company. They see a bunch of things they can do and want to do. And I will I will tell you, while not using those words, this is the same thing we've told people, which is pick your one or two low-hanging fruit that you can actualize now and focus your energies on that. Yeah, you have great ideas for things you want to do down the road. Focus on what you can do now, get it done, get it successfully rolling, and then move on to the next great idea you have. But focus. And that, I think, ties into your ruthless prioritization mantra.
Teams are so important in the structure. And I think, Max, another question that you had talked about was how can startups navigate the balance between long-term vision and short-term revenue growth, especially when selling into large enterprise markets?
Yeah, no, it's an interesting question. It's one of the hardest things to balance, right? And where does this issue come in, right? It comes in where you're an entrepreneur, you're looking to build some sort of valuable technology, and you see at the end of the horizon that it's technically feasible for us to be able to build this massive, beautiful idea. But for us to reach that horizon, we have to, take certain detours, right? Or a good example of that is Amazon, right? Amazon built a massive, organization that delivers various goods, right? Initially, they started off with books, right? They didn't necessarily have a full intention of being a book company, but nonetheless, they made this decision because of various benefits that come, the sheer number of books, the variety of books, and ease of storage and things like that. So that's sort of the preface, what leads to this sacrifice. Another thing that becomes dangerous is when you have this deviation or need for a deviation to be able to achieve the long-term goal, and actively raising a lot of venture capital money. Because inherently the time horizons for return between venture capital funds and entrepreneurs might be different, right? Most entrepreneurs ideally would be building companies that are going to exist for the next, 15, 20, 30, 40 years, while VC funds might be looking for returns that are a lot shorter term, right? 5 to 10 years. So this combination of the need for a detour, as well as VC funds looking for returns and looking for monetization faster, creates this pressure between the two parties. And the reality here is the way you navigate these pressures is by setting the right expectations with customers, with investors, being a lot more predictive and clear with timelines when it comes to transitioning from one market vertical to another. But to really set the right expectations and make them memorable, you have to tell stories. Tell stories that make it very clear as to, hey, this is why we're starting here, right? The stories should be funny, they should be sweet, they should be interesting and memorable so that they spread throughout the organization. So I guess that's sort of my primary feedback and point for anyone building how to navigate this.
You mentioned setting expectations, and I'm sure that there's always a tension to be managed with the inputs from an actual customer, and how do you manage that in your expectation?
The feedback from a customer?
Yeah, customer feedback base, and then your engineering teams, you mentioned you put on the front lines, like the way that you structure things. So how do you manage all of the different opinions and set those expectations?
Yeah, I mean, from a team perspective, it's really all about storytelling, right? Like, I'll tell you a funny story, right? At least for our case, Sonus, what we do is we build algorithms and then bring these algorithms for contact centers. The reason why we founded this company is because of a fascinating incident that happened to one of my good friends, Raul, who worked in a contact center and got mistreated because of the way he sounded. Raul was a Stanford systems engineer, who was forced to work in a contact center because that's the highest paying job that he could get at the time. And that story was something that really permeated the entirety of our organization. It infused the story of empathy and care, which also forced engineers to go into front lines to empathize with customers, right? To really be their boots in the ground. But then the expansion outside of this is more of a broader vision, right? In the case of Sonos, the broader vision is to help the world understand and be understood, right? And if you're looking at this concept as a funnel, what are the biggest things that lead to misunderstandings in communication? We're speaking the same language and we come from different locations. It's inevitable to have an accent, right? We're going to have different accents, and if it's an accent that you're not familiar with, there might be misunderstandings. So to us, when we're looking at communication in the same language, this is the biggest contributor to misunderstandings. And then you have a funnel of other items that you can optimize towards. And then you start looking at languages that never happened, like people communicating in different languages, right? Communications that would have never happened in the first place. That's where you have, language translation. So you see how this core story ends up leading to a broader logical breakdown of, what we're doing. And this is what we share with customers, what we share with our employees, with investors. And that's also partially how we maintain our long-term vision, right? So for us, we're not intending to be a call center company or we're intending to be more of an enterprise communication company, but starting off with contact centers, because it's
Right.
same thing with Amazon with books, right?
But that goes to the initial discussion, which was the ruthless prioritization, right? So Amazon started as a book company. They didn't want to ultimately end there, but they knew this was the building block for what they wanted to do. And it's the same in your case. You're establishing the building blocks of what you want this to ultimately be, and you're doing it in a very logical way. Now, one of the things we touched upon, and one of the things that I see quite often, and I welcome everybody to jump into this, is this concept that we brought up, which is managing customer expectations, et cetera. And I think the other part of that is effectively understanding and meeting customer expectations, right? And this is an issue that we've seen in a number of companies as well. And maybe the panel can speak to how they or their portfolio companies address it. But it's like you have a sales team that's focused on making sales at all costs. And you have an engineering team that's focused on making the best possible product in the world with all the features that they think are really cool, right? And what you want is a situation where both of these people are talking to each other, but more importantly, also coordinating directly with your customer base, your existing and your potential customer base, to say, okay, we think this is a great idea. We think this is a great feature, but what are you guys looking for? What makes your life easier? How have you seen that navigated in companies, and have you seen it as a problem like we've seen it, or is it normally not an issue?
So the joke that we always told at both Atlas and Geoforce was that the worst nightmare for us was that the sales and engineering team to get together in the hallway and make a baby. And what I mean by that is the engineering team and the sales team, they meet, bump into each other in the hallway or at lunch or whatever. And the sales team says, oh, customer wants X, Y, and Z. They want it to be yellow and green and delivered tomorrow or whatever. And the engineering team says, oh, I could do that. That's easy. That can be done in 2 sprints, 2, whatever. And then they go and do it. And that's kind of the role of, the C-suite or if you're a much larger organization, obviously a product management team, product owners and all that get involved in architecting what that looks like. And to your point, getting the customer feedback formalized, not, informally collected from Joe sales guy or whatever out in the field to make that happen. That's definitely the biggest challenge at the emerging growth stage where people don't have product managers. The engineer and the sales people sometimes are the same person. The founder might even be the person who writes the code, so to speak, and is the one talking to customers every day. And so the joke about having a baby in the hallway or whatever, is actually in their own head. So it's definitely a challenge. I see Maxim smiling. It's one I'm sure he's still dealing with and will always be dealing with. But the best way to kind of solve that is going back to your earlier point about ruthless prioritization, about having the right minds in the room to prioritize everything properly and set the right expectations. And kind of following on Maxim's earlier point, and sort of what Constantine's been saying, the best way to accomplish a long-term objective is to hit your short-term objectives. Because hitting those short-term objectives is the bridge to get to the long-term, whether that be customer revenue or venture financing, whatever it is. You have to hit the short-term stuff to get to the long-term stuff. So you can't lose sight of that.
And I guess an aspect of that too is, okay, you want to be actively listening to your customers, you want to accommodate their needs, but I think in my experience, you also have to be discerning in the sense that if nine customers are fine with a feature set you have, and one says, oh, I really want this in red, gold, and chartreuse, is it worthwhile to spend the time and energy to incorporate that feature set? So it's once again prioritization. What does most of my customer base need now versus what does one person who has a unique need, and is it worthwhile to meet that unique need?
Right.
I would add to that. Oh, sorry, go ahead, Glenn.
Well, I wanted to take your analogy of sales and engineering meeting in the hallway. What's missing in that equation is a parent in the middle, the person who owns the product. And if you don't have a product manager, the CEO needs to be that product owner to make that decision until you're ready to have a product owner. But that person is the one who needs to make that decision and make sure the kids in the hallway aren't doing what they shouldn't be doing.
Yep. And the other thing that comes up is that the money, so customers might say, oh, I want it in green, I want it to be faster or this or that, but I'd only be willing to pay $10 for it, not $20 for it. And usually the sales, they're not asking that question. Engineering doesn't care about that, right? So having to inject that element of okay, that's great, and they want it in 3 months versus 6 months, but will they pay for it? And how much will they pay for it? That function of
well, not just that, Vincent, but how many customers will pay that much for it?
Mm-hmm.
We're not here to close one enterprise deal. We're here to serve a market. And so how do we make that trade-off?
Yeah.
And speaking of money and customers who are stakeholders, I think it's important also to talk about if for portfolio companies, they're investor stakeholders like their VCs and PE. So I was part of VC University. I know attended last year. I know Adam, creator and founder of that. I would love to hear your perspective for companies that are receiving a VC check for the first time or have been, and what's your advice for them when they become a portfolio company?
Yeah, I think the first is just to understand what you're doing. And there's a saying, which I think is a little extreme, but I like it, that the day you take your first dollar of venture capital is the day you've started the process of selling your company, which on some level is true in the sense that, right, that VCs are investing in your company with the expectation that you will grow rapidly, and then there'll be an exit event where they'll get paid. It may be acquisition, it may be an IPO where you're sort of selling much of your company to the public. But in either case, you're starting this short, maybe long process of giving up control, both economically and sort of control through your board, through certain voting rights. So I think just understanding the trade-offs.
And as a corollary to that, do you have any advice on board dynamics, especially with respect to VCs on the board and type of people that you want on the board for portfolio companies?
Let me. That's a great question. Let me add to that and expand on that, which is, I'd like the panel to also speak once Adam finishes asking that question, which is, what's the most effective way for portfolio companies to manage VC and PE expectations? I'm sorry, okay. Adam.
No.
A hard question.
Yeah, so I think, generally speaking, when we see the board composition change from just the founders, and when you start a company, it's often, the board consists of often one person, the founder of the company, and then it's usually when you do a priced round, a Series A or even a Series Seed, where you're negotiating a value for your company and then giving up board seats to the investors. Generally speaking, when you're raising money via convertible notes or safes, there isn't an expectation that you're adding those investors to your board, although it can happen. And then, usually when you do that first sort of price round, your Series A, I think the idea is generally you're adding one, maybe two, if you have two board members to your board from the VC funds. Usually you'll set a seat aside for an independent director, but most startups, even though I think they should, aren't actually adding an independent director until much later on. And then the one thing that's often negotiated is, so, as the founder, you'll probably almost certainly control the common stock. So when you have seats allocated to the common stock, that's usually going to be your seat and maybe your co-founder's seat. Oftentimes, the investors will push for having that second seat be a requirement that it be the current CEO of the company. And in the short term, it may not matter because you might be CEO in addition to being founder that controls the common stock. But if there comes a time where you're removed or are no longer CEO, you have to give up that seat. So just something to think about. That's one thing that can often be negotiated there.
So Constantine, thank you, Adam. And Constantine, to answer your question, one of the things I counsel CEOs on is never surprise the board. So we're going to make some commitments at the beginning of the quarter, and sometimes we're going to make them. But the minute we think we're not going to make them, communicate with the board. This goes back to Max's earlier comment about managing expectations. So we can still have an excellent quarter and not make the number, which is what we want, because we've managed the expectations of the board. We don't want to find out at the end of the quarter we surprised everybody and we just missed the target and we look like we haven't succeeded.
Glenn, to add to your point, and it's an excellent point, what we always tell folks is that silence is never good. Communicate and over communicate, whether it's to your board or your stakeholders, or your customers, whatever the case may be. People want to hear what's going on a periodic basis. And if they don't hear what's going on, for whatever reason, most people's thoughts go to a dark place immediately. What's going on that I'm not hearing anything? So communicate regularly, provide updates. And like you said, if you're off on your targets a little bit, but you're still trending in the right direction and you've been transparent about that, odds are you're going to have a good response from all your stakeholders.
Interestingly enough, where I more often see the silent treatment occur is the other direction. And sort of, if you think about the economics of venture, and if you've not heard about the power law, you should Google that. But if you imagine a VC's making 100 investments out of his portfolio or her portfolio, her expectation is that a very small number of those investments will be really successful, and then all of the others will be failures. And so, VCs are often, making these investments, and then at a certain point, more or less writing them off, and then focusing in on the investments that they think are their winners. So even though it's sort of pitched to you as this sort of long-term relationship, I mean, I can't tell you the number of times when I was practicing and now working with founders, where you sort of hear, that our VCs won't return our calls or emails, and they're often on the board. So just something to be aware of, that it goes both ways.
It's such a brilliant point because, VCs have so much on their plate. And like you said, they're focusing on those 3 or 4 100x, 1000x winners. I think it's important for founders who aren't aware of this. They need to be aware of what's called intermediate scenarios. And what I mean by that is typically, deals can be, your company can be a stunning success or a stunning failure. A stunning success is everybody gets paid, the preferred, the C-suite, the common, the advisors. I mean, it's everybody's, basking in success, toasting champagne. The stunning failure is it goes to zero. And even though it's a awful situation, there's a kind of a element of fairness to it where everyone gets zero. The intermediate scenario is like an example with the Zoox litigation, where Amazon purchased a company for about 1.2 billion. Sounds great. The problem was it was a down round from 3 billion. So what happened was the litigation's ongoing, but what they found was the board was conflicted. And so that, the preferred got like $1 million, probably got their money back. And there was 200 million carved out for, special people in the company, and the common shareholders sued. And so what you need to do is we all want a stunning success, but if it is an intermediate failure, just advising companies, have a special committee, disinterested process, and a fair outcome, and generally courts will defer. But really those intermediate scenarios, you have to be cautious of when there's an exit.
And it's not necessarily, I mean, I wouldn't necessarily term it an intermediate failure. When we were doing investing on our side, much the same thing as we've discussed here, we understood there was going to be some strikes, there was going to be a lot of base hits, and there was going to be a few home runs, right? And we try to make sure that our base hits were solid. We swung for the fences periodically. And we accepted that there were going to be some strikes and some outs.
What do your base hits look like? Like what's a base hit?
A company that did reasonable ROI for us, but wasn't like a huge success.
Yeah.
That's the best way that I can characterize it. But hey, that's the nature of portfolio theory, right? That's why you spread the investments across numerous companies and hopefully help build up some really successful ones.
The other term for people to go Google, since we're assigning out Google homework here, is
it's the
the zone of
professor.
indifference, especially for entrepreneurs who end up having like a preferred stack and common and all that. Go Google zone of indifference, which sort of hits on some of these points here in terms of where preferred shareholders make their decisions. Last thing I would also say on the earlier question about the investor-entrepreneur relationship or whatever, I would say that like when I was on, we didn't ask enough questions of our investors, and they can't read our mind. They might know what they think they know, and they're in quarterly board meetings and get investor updates and talk to you once a month or whatever, but they really don't truly know what's inside your head. So it's on your side as an entrepreneur to raise your hand as often as you think you need to, and always end conversations with things they could help with. Like the classic meme is that investors always say, "Let me know how I can be helpful." That's not just a rhetorical question. They literally mean like, "Let me know how I can be helpful." Like specific things like these customer introductions or reviewing this plan or whatever it is. Like be tangible. We can ask your investors for, and to the point everyone's making here. As long as you're still not into one of those the bad area or whatever. They generally want to be helpful and want to support you where they can, and but it's on you to kind of raise your hand and make known what that is.
Yeah, if I could also add in to this is a really relevant point, very interesting one. From like a founder perspective, in my opinion, it's so critical to like if you think about a very successful entrepreneur. In the career of a very successful entrepreneur, they might have done, I don't know, 10 to 15 fundraisers historically, versus a venture capitalist who is very successful. They've done an ungodly deals, and they've negotiated with every single possible entrepreneur that you could imagine. So because of that, you sort of have like a skills mismatch. One person who does this, this is a huge portion of their job, right? Versus another person who is mostly focused on building and maybe less so negotiating. This feels like a necessary nuisance maybe for a lot of entrepreneurial folks. And because of that, it's so critical to have private counsel as a founder, as an entrepreneur, someone that you can trust that represents your interests. Because if you even think about the interests of company counsel. The growth and success of the company is related to the financial returns. So company counsel is focused primarily on that. Who's going to represent the interests of the founder, right? And Adam, this goes to your point, right? Things as simple as, hey, you know, the CEO has 2 board seats. One is contingent on the CEO title. They step away, you know, you lose a bunch of votes, right? That's a critical thing that, you know, company counsel might not tell you versus personal counsel might tell you to negotiate. So the sooner you have someone on your side representing your interests, the better.
And agree,
That's
Max.
a good point that company counsel represents the company, not you as the founder. And there's a strong argument to me from like a governance perspective, that structure where the board seat is tied to the CEO is in the best interest of the company, but it might not be in the best interest of the founder. So good point.
I was just going to add too that as the company scales, those interests divide. The CEO and the company's interests divide. As in the early stages, they're almost one and the same, and as they scale, it diverges.
And
to some extent.
I'll add one more point, which is a very valid point to what Max was saying. You know, because there's this disparity in experience between the professional investor, the VC, and the founder who raises capital intermittently, it truly does become important to have sophisticated company counsel to help guide the CEO through this process and help them understand what the best possible deal can be for the company, you know, and find some balance with what the VCs are proposing. That doesn't obviate the need for personal counsel, perhaps, particularly as the company grows. But I think it certainly points to the need for sophisticated counsel at every financing stage that the company is going through.
Glenn, that's a great place for us to ask you what you're seeing for CEOs to scale their companies. What are some of the key factors that they need to focus on? What are you seeing?
So different from what we have been talking about is the word accountability. So one would think that CEOs are holding everybody accountable to the things that we ruthlessly prioritize, but I'm regularly surprised at how CEOs shy away from that element of accountability. And what I keep hearing is, well, I'm worried that if I come down hard on somebody who's not delivering, they'll leave the company. And I get that. And it's a misunderstanding of what accountability is. Accountability is, I've made a contract with an individual reporting to me. They've committed they're going to do something, and now they don't do it. I need to have a conversation with them. It's only about a conversation, because if somebody feels like they can make a commitment to the CEO and not do the work, they're gonna get away with that. They're gonna continue to pursue that pathway, and so I believe one of the things that CEOs do not do as well as they can, especially in a scaling organization, is hold each and every person who makes a commitment accountable to that commitment on a continual basis, on a weekly basis. And so that's my strongest recommendation for CEOs, to ensure that everybody is doing what they have committed to.
Max, I feel like you might have something to say about that regarding not being afraid of people leaving or quitting and how to manage all of that.
Yeah, no, it's very true. I'll never forget this. You know, year one of building our company, and we had one of our main engineers who was building our desktop application, which is a package that we deploy. We had them leave, and you know, they simply sent in their 2 weeks, and that's it. I remember speaking to a bunch of investors talking about how this is the end of the world. Like, I don't know what we're going to do. Like, how big of a problem is this? Things like that, which is fairly normal. But now, you know, since then, to date, we've raised like 120 million, something like that. Now someone leaves, you don't even remember, right? You don't even know. When we scale up to like 300 people, it's a little bit harder. But no, it's true. The thing with running a company and being the CEO is it's really, I mean, I'm not a dad or anything, but I would imagine it'd be very much like parenting. You know, you would assume that your employees, people that work for you, are constantly seeking ways to sort of reach their objectives and do so with as little effort as possible. And your objective is to sort of set the threshold of what behavior is acceptable and what isn't, right? How much are you going to allow for the folks to cut corners for them to reach their end outcome versus not cut corners? And whatever you think you let through, let pass, assume that you're going to let pass for a bunch of other folks. So you always have to ask yourself, hey, if I let this person through, allowing for them to not chew them out for an under delivery, you're setting the same precedent for the entire organization, unfortunately. So it's kind of, this is why it's really hard to work with friends, right? Why it's hard to hire your friends, because you end up having to have these difficult conversations, and business is business, right? So
although there's a study that says working with a best friend has the strongest correlation to job satisfaction. So, but I don't think being a startup founder means you're happy or satisfied.
A related kind of HR-ish topic related to scaling, the kind of original question on scaling, is the saying that what got you here won't get you there, right? So at the beginning, you need people when you're 5 people, 10 people, 30 people, you need people who can do lots of different things. They can wear lots of different hats across, let's call it different functions. But then as you get bigger, you need to start siloing off a little bit more, having like not just a go-to-market person, but someone who's sales versus marketing, and then inside sales versus outside sales, and then sales operations, or product management versus engineering, all that stuff. At the beginning, you need people who can do everything, and then later on, you need people who can specialize. And sometimes people who are good at doing a lot of different things aren't going to be the best at doing the one thing, so to speak, and you have to let them go, right? Or just as you're growing as a company from 1 million to 10 million, 100 million, there's different needs of the company, and you need different types of people to do that. Some of the people will grow with the company, but the company's growing really rapidly. Even no human can grow that fast. You may have to let some of them go. And that's probably one of the harder things to do, that I know I learned it the hard way the first time and did a little bit better the second time. But it's a challenge for everybody. I'm sure that, Glenn and Adam, everyone's dealt with before as well.
It is, Vincent. Many times I hear, but that person was with me in the early days. Yeah. They've been working with me for 3 years. They're so dedicated.
Loyal, yeah.
They're such a nice person. And we have to separate ourselves from what's good for the company. Is that person was great at the time. They needed to be scrappy. They needed to wear a lot of hats. But now we as a company have scaled, and the people need to scale with it, or they're not going to be a fit. So Vincent, your point's dead on.
And I know a few that I let go, they ended up being much more successful at the smaller scale, doing the thing they were comfortable doing for me 3 years ago or 2 years ago. And they were uncomfortable, even though they wouldn't admit it, but they weren't. And now they go back to, let's call it the smaller environment, and they're thriving. And so it's actually better for them as well, to use your parent analogy, Maxim, right? It's better for them sometimes to leave the house a little bit and go do something, try to experience something else. Yeah.
That's right.
Let me ask you guys a question as we're slowly kind of moving to the end of this, which is more of a to a certain extent a philosophical question, but having been around for a few decades, the question to the group is, for portfolio companies, for entrepreneurs, do you think, what is the outlook now versus historically for starting a good company, growing a good company, funding a good company? Are we in a good place? Are we, is it similar to what you experienced when you were doing it in your days? What's different? What's better? What's worse?
The better is it's easier to start a company, faster to start a company, cheaper to start a company. And not everyone knows about AI, but there's other factors there with remote stuff and just information's out there, AI, all that. Easier to raise money. There's more money out there. I
didn't want to ask a leading question and point you to the answer, but that was kind of my intuition. So it's great to hear that,
because it's also just easier to find money if you need it, right? You can find and sometimes it's almost worse. Like the analogy I draw is that you go to like Cheesecake Factory you got information overload of menu options. Like you can't order like your appetizer, your main course, whatever. There's too many choices. Versus you go to Costco, they give you like 3 choices, like small, medium, or large, or cheap, middle, or more expensive. 3 options, make your decision at Costco versus Cheesecake Factory. And we're almost in the world now where everything looks like Cheesecake Factory. So that's mostly a good thing that the options for either capital or headcount or whatever resource you need is out there. But that's also could be a bad thing if you have too much information, you can't make decisions, or you end up making bad decisions. So that's maybe the con of what you asked about.
Now, Vincent, I don't know if that's a personal dig or not, but I end up having lunch at Cheesecake Factory almost every day, so I'm not sure where I stand in all of this.
But
But
you probably know exactly what you
I
want.
find
You
it
probably
beneficial.
order the same 3 or 4 things most of the time, is my guess.
I alternate amongst about a dozen things.
That's good. It's a good mix. Good
Quick
rotation.
follow-up. Quick follow-up for Vince. Vince, I want to hear everybody else's too. But Vince, what's your advice to companies raising now, like on the Rule of 40 or on like metrics, as far as when they're thinking about how they look at their company now versus how it was before?
Yeah. So first of all, Rule of 40, just for audience that might not know, is highest level is the sum of your growth rate, let's call it, and your profitability. So it sort of implies the trade-off between you grow faster but be less profitable, or grow slower and be more profitable at high level, right? And Rule of 40 means you kind of want to be around 40%, 20% growth and 20% EBITDA or whatever, something like that to get to Rule of 40. And on your question here, that's been around for a while. For a while, there was a push towards like a rule of X, where you 2X the revenue growth in that thing. You overweighted revenue, and profitability was just 1X. So a higher number was better, but more centered revenue growth. In the post ZERP or post zero interest rate period era, it kind of slanted again more towards profitability. And so we kind of zigzagged a lot the last 5 years. We're now back to kind of a steadier Rule of 40. And now there's even a new metric that's making the rounds in the investor world the last like 6 months or so. I don't know what's called the rule of, but we'll call it what we want. It's the rule of the 40 plus your retention, or the negative of your retention rates. So it's really important now to have sticky revenue and have retention. Like don't have people churning, have like your revenue be durable and all that. So if your retention rate is 90%, meaning you retain 90% of your customer base, let's call it, every year or whatever, your churn rates will call it roughly 10%. So then you add that, or subtract that, sorry, to get to a new rule of something. Just to add, another layer of metrics to analysis here. But that's becoming more important, is the durability of your retention rates and churn. It's much easier to keep a customer and keep growing them than to go try to attain a new customer. So
that's right. My favorite metric for most startups is net revenue retention, which is what you're really talking about, Vincent.
Yeah.
Glenn, Adam, Max, going back to sort of the broad thematic question, what's your feeling about folks now building, funding, growing companies? Good environment, better environment than in the past? Cheesecake menu open to them? Just have to be discerning?
So I've seen that it's bifurcated into, do you have a good AI story, or are you something else? If you're something else, it's a lot harder because there isn't as much money being allocated if you're a non-AI play. If you are an AI play, if you're a good one in particular, there's almost infinite money that could potentially go into that sector. So that's what I'm saying.
Yeah, I mean, I think venture is an industry that likes to project itself as being contrarian, but it almost, exclusively acts in conformist ways. And I think sort of FOMO drives a lot of behavior. And so I think I think, there's sort of this feedback loop as far as investing in AI startups. I also think there's been some interesting developments, post Silicon Valley bank implosion. I think we're seeing, there was like a 10-year period where you would do a round of financing and then almost immediately open up a credit facility on incredibly favorable terms with an SVB or the like. And so, that's changed a bit. I think I mentioned this earlier, but, when I practiced, startups were raising a few $100,000 on convertible notes and safes. Now it's many millions of dollars. So, there's some changes there. But yeah, I think Glenn's point is a good one.
Max, you're in the thick of things right now. How do you feel? Positive environment? Feeling good about how things are?
So, you know, Sonos is crushing, right? We're doing very, very well. But when I look at the macro landscape as to how things have evolved, you know, there's this whole piece on, you know, we're going through the biggest revolution right now in software development ever, right? And building technology, shipping code has become a lot more streamlined, a lot more simple, a lot more optimized. And because building has become something that you can do very quickly, the rate at which you get competition has also accelerated quite a bit. So, you know, say I'm building some sort of a, you know, website that services a certain customer set, you know, competitor can build up this website in a day, right? Like even less than a day, maybe with one voice prompt. Obviously, there will be all sorts of vulnerabilities and concerns there, but still, if you're a senior enough software engineer, you can patch it up pretty quickly. So because this shifts away technical moats for startups sort of start leaning closer into go-to-market moats associated with distribution, with marketing, and things like that. And it becomes a little difficult as a company CEO to rectify this like deviation between being a sales dominated organization versus an engineering or a product dominated organization, which goes back to the earlier point someone discussed here, you know, about, you know, what was it, engineering and sales huddling together in a room. It becomes really relevant and hard to sort of keep this balance. Because the more competitors you have, the more the sales cycle becomes dominated with features, right? Saying, hey, you know, we can win this account, but we have to add in feature XYZ. And then when you have 50 of these feature requests, you sort of have a lot of trouble prioritizing what do you put first, what do you put second. So the real companies that I see emerging that are going to be really relevant are companies that figure out some sort of a software moat that is closer to the stack of hardware rather than to the stack of software. Like in our case, for example, you know, we're building virtual hardware, virtual software. And because we're doing that, you know, you're working with, you know, your own C code, your own hardware QA sets and things like that. So that's a critical element. I think in general, VCs, I think Adam, you said this, it's very spot on, or Vincent, that they're a lot more, they want to put themselves out to be a lot more contrarian than they actually are. You can see that where everybody has the same narrative, same worldview about AI and so forth. And it's hard to shine when sort of someone has like a clear narrative in their mind as to what will work and what won't work. That's where I feel like you go to alternative investors, you know, maybe more PE funds rather than VC funds, which have slightly more conservative takes or different views and things. So
that's a good point. That's a great point, Max. I think we have a couple of questions in the queue from folks. So why don't we see if we can hit that, and then we'll go from there. Christina, do we have some questions in the queue?
I have a question in the queue. We've got about 5 minutes left. The question says, in your opinion, which is the best way to build a high-performing sales organization, and who can help a founder or CEO to do that?
That's a great question. Who wants to take that one?
I mean, I could start with it starts with the founder or the founding team setting the you know, all the things we all talk, mission, vision, all that kind of stuff of what you're trying to do, what your ideal customer profile is, who you're going after. And then you can have people come in and help with the execution side of it, the accountability of your sales team, all that kind of stuff, marketing, whatever it is. But it starts with the founder, the founding team, establishing what it is you're trying to do and making sure that's properly defined, expectations are set properly. What you do, and maybe more importantly, what you don't do yet is set for your success. Otherwise, if you don't set the boundaries of what you do and don't do, it's hard for the sales team to be successful. because they're just gonna try to sell everything to everybody.
So I've seen a pattern in hiring the CRO for a high performing organization, and it's twofold. One is that CRO needs to understand the customer problem. That is how the company got off the ground. It was a founder-led sale to some point, and now we need someone who knows and understands the customer problem. The second is they need to not just be great at selling, they need to be great at scaling. In other words, they are here to build an organization while they are selling. And ultimately, they need to bring in great leaders themselves and bring in an operations organization all to support what has to be built for sales to work. So those are the two most important factors.
That's really great, Glenn. Also wanted to see if anyone wanted to add anything else to that, because one of the questions is, what are some of the common characteristics of companies that actually make the transition from a series stage of an investment to an exit?
I am going to intervene here for a second and say this is an excellent way for us to wrap this up. And why don't we ask each of the panelists to give us one or two of their critical points that they think are most important with respect to building a successful portfolio company. Who wants to start?
I can go first, and it tags on to what I was saying earlier. There's a certain point, it's hard to pinpoint exactly that point, where we move from being a scrappy team that Vincent was describing earlier that wears all hats to where we begin to specialize. And at that point, the CEO's most important job is to hire a great leadership team. It's a complete shift in the CEO's responsibility, but it becomes the most critical factor in enabling a company to scale.
Max, how about you?
How to build a strong sales team. What worked for me was, so first of all, I'm not a sales guy, more on the engineering and product side, but what worked for me is,
and you're doing okay, so we want to know what worked for you.
Thank you, sir. Yeah, so what I would say is, just echoing the same feedback that I think Vincent and Glenn mentioned, right? Has to be founder driven for a pretty long time. The reason why is because when you look at sales from a funnel perspective, you have to understand what are the biggest breaking points along my sales cycle that I need to optimize on, right? What is something that you can throw people at the problem and it'll be solved versus more permanent that you can't throw people at the problem. And based on these indicators, you first have some high level metrics, which are important for VCs when they're putting in a check. And separately, you also have some visibility on what kind of a sales leader do you want to hire, because they come in their own flavors and types, and you want more of like a person that's just, career account executive, or do you want more of someone that's sales engineering type profile, or someone that's more of a marketing type profile, or an expansion type profile, right? It's account expansion type profile. So it's really hard to figure out up until you understand what would a repeatable sales cycle look like. Based on that, you bring the right leader. For us, the hardest thing is really just account expansion, because the organizations that we work with are like 500,000 people. So mapping out the organization, doing the right marketing there it's hard. But yeah, that's the feedback.
Thank you, Max. Adam, how about you?
Yeah, I
One
think
key point.
the best sales teams and people build relationships, ask questions, and solve problems.
That is succinct, and that makes perfect sense to me.
Constantine, I was going to, oh, sorry, go ahead. Go ahead, Vince.
Go ahead,
Vince,
Jerome.
Vince, you go ahead.
Sure. So the question on like, how do you get to a scaled exit and all that? There's two different types of buyers at the highest level. There's the financial buyer, like a private equity firm buys you out or whatever, or there's a strategic acquirer. If it's more the financial buyer, they're going to need this thing to keep working, quote unquote, on its own. And so the sales engine, the go-to-market engine's got to work. You got to be able to transition from founder-led sales to founder-less sales, where the founders have to be involved. They can still sell stuff because otherwise you're too dependent on that person on that side. On the more strategic acquire side, presumably they're a bigger company that has a bigger sales team and a better sales team, maybe not better, but bigger. they don't necessarily need your sales engine to be perfect, so to speak, but they need your product to be good, so they can fit into their portfolio stuff, right? So there could be potentially two different focus areas there. But either way, one thing I would say in terms of trying to get to a sale, like if you're going to be acquired by an institutional investor of some sort, or a sophisticated buyer of some sort, and this is going to sound like a commercial for law firms and stuff here, but you're going to have your law firm, accounting firm, all that stuff. The books need to be right on the corporate records, all that stuff, because nothing kills the deal faster than you think you got this, you get in there, like, oh, there's a surprise here, surprise there. Don't have this set up properly here or there. And then just you get deal fatigue and you go to the next shiny deal you can work on that is cleaned up. It's good corporate hygiene and all that. So I'm not just saying this because there's lawyers are hosting this this forum here today. But the first startup, we did not have good lawyers at the beginning, and when we sold to private equity, it probably cost us millions of dollars in terms of deal value and all that, having to clean up stuff. Second time around, we hired a really good law firm, a really big tech firm here in Dallas, and they've been our lawyer for 20 years now almost. They had it done, quote unquote, the right way from day one. And we expanded internationally, like 6 different countries, and they helped us do all that as well. And, it was good. So this is a little bit more on the selling side, but when you want to get to that stage, you got to make sure your books are right. Just like trying to sell a house, you have to have the right inspections and the right plumbing and all that stuff, right? It's got to all work.
Thank you so much, Vincent. And if you don't mind, we'll be bringing you into our proposals from now on, so you can for potential
We'll
clients
record
understand that. Thank you, everybody.
Quick ad, Constantine. Quick. Well, because I wanted to add, Max mentioned, really strong sales. Glenn mentioned strong leadership team. Vince mentioned understanding who the buyer is, and Adam mentioned the relationship with your customers. I want to add a strong battle-tested board, because they can help you navigate the complex situations you're going to encounter on the way to exiting.
Absolutely.
Well, we want to thank everyone for joining us today. What an amazing discussion. We first want to say thank you to each of our panelists for joining us today and bringing your expertise. We're so grateful for you. Thank you to everyone who's attending. And we will send this recording out to you. Feel free to share it with whoever you'd like to. And we hope you have a great rest of your day, and join us again on the next one at Fogel and Potamianos. If you need to reach us, you can reach us at info@fpgeneralcounsel.com. Have a great day.
Thank you.
Thank you, everyone.
Thanks, everyone.
Thank you.